So during the week, I had some questions regarding what's called an in-the-money strangle. And a question said, I would like to see in-the-money strangles in the system, in the power options search. Right now in the power options search, we just show the out-of-the-money, the OTM strangles. And the thought is that the in-the-money strangles have a better delta and are better trades. Well, let's take a look at the combination of the two and what the two exactly are, and is one really better than the other? The definition of a long strangle, buying a strangle, is typically that you're going to buy a call and you're going to buy a put speculating on a direction of the stock in one way or the other. You just don't know which one. Strategy for around earnings, or if you're expecting a big event, or maybe a long-term position if you're expecting a steady decline, but don't want to be fooled if the stock moves up. The common practice is the out-of-the-money strangle. So if I have a stock trading at 50, I might buy an out-of-the-money call above the stock price, let's say the 52.5 for a cheap price. No intrinsic value, it's out of the money. At the same time, I might buy an out-of-the-money put below the stock price, let's say a 50 or a 47.5. Again, no intrinsic value on the position. It's all extrinsic or all time value. Now, it's similar to a straddle, but the straddle is done at the same strike price with the same expiration, which gives you that V profit and loss chart. The strangle is done at different strike prices, so you get more of a U or a pan-shaped profit and loss chart. Again, this is done when we expect a big move on the stock or a significant move on the stock, either short-term or long-term, but we're not sure of the direction. Now, the other day when ATVI was trading at 63.20, so I could consider buying an out-of-the-money long strangle by buying the 8th of December 61 put for $1.16. The delta was a negative 0.315. So if the stock moves up $1, I'd expect to lose about 32 cents on that put for the 8th of December expiration. This put is at 61, stock's at 63, so it's about $2.20 out of the money. At the same time, I could have bought an 8th of December 65 call, about $1.80 out of the money, and the price was $1.24. The delta of my call, the out-of-the-money call, is 0.38. So if the stock moves up $1, I'd expect to make 38 cents on the call. My total debit is $2.40, or $240 if I bought one contract of each. But my maximum risk, if I do nothing between now and December 8th, the stock stays right between 61 and 65, both options would expire, I'd lose the full 100% of whatever I invested in the position. Now I have a low delta on the call and a low delta on the put. But what's important is the delta difference. And what we mean by the delta difference is when we start off any strangle, whether you're in the money or out of the money, you start off delta opposed, not delta neutral, you're delta opposed. So the stock moves up 1 point, I might gain 38 cents on the call, but I'll lose 32 cents on the put, or 31.5 cents roughly. So that means for a 1 point movement in the stock, we're only going to gain 6.5 cents on the position. Okay. Now, the upper break even for this straddle is 67.40. The lower break even is 58.60. You just determine that by the net debit plus the long call. That's where you need the stock to be trading to break even. And the long put strike price minus your net debit. Okay. Oops. There we go. Okay, so not the best profit and loss chart, I know. It doesn't go to the full range of the different strikes. But here's your typical U profit and loss chart for out-of-the-money strangle. I bought the 61 put. It's a pivot point. And we bought the out-of-the-money 65 call with a stock trading around $63. Okay, that's your out-of-the-money strangle. What's the difference with an in-the-money strangle? Well, with the in-the-money strangle, I'm just going to reverse the options. Instead of buying a 61 put, I'd buy the in-the-money 61 call for a price of $301. This was the price on yesterday, November 9th. At the same time, I'd buy a 65 put, which yesterday had the cost of $3.40. Well, because I'm using in-the-money options, the delta of that long call is more than double. It's at about 69. And the delta of the long put is about 62. But negative 62. Remember, the stock moves up 1 point. I expect to lose 62 cents on my put option. Now, the total net debit is 641. So this is not quite 3 times, but it's about 2.5 times the cost of the out-of-the-money strangle, where we used out-of-the-money instead of in-the-money options. Remember, the stock's trading at 63, 63.20. The maximum risk, though, is still 240. It's not 100% of what you invest. Why? Because one of these two options, if the stock's trading between the strike price, actually both options, if the stock remains between the strike prices and you hold it all the way to expiration, they won't go to zero. They'll both retain some value. So if the stock stayed right at 63, your 61 call would still be worth $2, as would your 65 put. So you could sell to close that, get $4 back, but you're still risking $240. And this only becomes 37.5% of your total investment of $641, but the monetary risk is still the same. And the delta difference is still the same. So in this case, for a 1 point movement in the stock price, I'd expect to gain 68 or 69 cents or so on my long call. But at the same time, I'm going to lose 62 cents on the put. Right? So again, this comes down to really about a gain of 7 cents for a 1 point movement in the stock. The out of the money was 6.5 cents. This is close to 7 cents. A little bit better, but not great. The break-evens, assuming you held it all the way to expiration, are exactly the same. 58.59 instead of 58.60. It's 67.41 instead of 67.40. Same delta difference. Same upper and lower break-even. Okay? Now, sorry about that. There's your profit and loss chart for your in-the-money strangle. I know it looks exactly the same because they are parity trades, but you can see here the total cost for now my in-the-money 61 call and my in-the-money 65 put for December 8th is $641. But again, if the stock stays right at 63, I'll get $2 back for each option. So the worst case scenario, if the stock's anywhere between 61 and 63 at expiration, my apologies, 61 and 65, is a max loss of $240. Only 37% of what I invested, but the same monetary risk as what we saw with the out of the money position. You have the same risk reward profile. They are parity trades. The monetary risk is equal. The upper and lower break-evens are essentially equal. But are in-the-money strangles better trades because the deltas are better? Well, maybe if you prefer higher deltas when you're buying options. But remember, the delta difference between the two is exactly the same. You need a 2 or 3 point movement one direction or the other for the gain on one option to start countering the loss on the other, whether it's an in-the-money or an out-of-the-money strangle. Strangles, these buying strangles, or even selling strangles if you look at it that way, but they don't start off delta neutral. They start off delta opposed. Really more applies when you're buying. So when the stock moves up 1 point, I'm pretty much, in this scenario, going to gain the same amount on the call that I'm going to lose on the put. And if the stock falls $1 to start, I'm going to lose the same amount of money on the call that I'm going to gain on the put. You have to wait for a bigger movement, maybe 2 or 3 points, before the deltas switch enough where the gain on the put option, if the stock's falling, is outpacing the losses on the call. Okay? Now, there are some other subtle benefits to the in-the-money long strangle. I'll agree with you. And, for example, if I'm selling here, this is our in-the-money long strangle, remember, if I've got the 61 call and the 65 put, and after the first 3 or 4 days, ATVI is hanging around 63. Well, I may choose to sell maybe a November 25 or 24, sorry, November 24, maybe even November 17, 63 or 63.5 call. With the in-the-money strangle, this is more of a calendar spread or a bull call spread. You're using different expirations, but it's more of a calendar spread or a bull calendar. Why is that important? Because if I try to sell a call to generate premium to knock the cost basis or the risk down, I don't have any further margin because I'm selling a call that's above my long call strike price with the in-the-money strangle. If I did this with the out-of-the-money strangle, remember where our 65 call was purchased and sold to 63, this would be more of a bear spread, a calendar bear or a bear call credit, but now I'd have to put up the margin requirement of an additional 2 points. I'm not really going to lose that if the stock moves up. I'm not going to lose the whole 241, but remember, you're still going to lose on the put and you're going to lose on that new spread. That's one advantage that the in-the-money strangle gives you, is that if you do adjustments, plan on converting them to a calendar or something along those lines, well then you don't have to put up the extra margin. Whereas the out-of-the-money strangle, you would need to put up the extra margin in that case. All right. But this is kind of where this comes into play. And I have a question coming up related to income methods and radioactive positions, it looks like. And this is where the customer was going. The customer wanted to create and build in-the-money long strangles, buying an in-the-money call and an in-the-money put to substitute for a radioactive trade, the married put position that we advocate. Rather than buy the stock and buy a far out in time put option to ensure the position is single digits, they want to substitute the stock cost and use leverage to buy an in-the-money call in place of the in-the-money put. I'm sorry, buy the in-the-money call and the in-the-money put, but buying that call in place of the stock. It's a leveraged position. A fifth to a sixth to maybe a seventh less of the cost of buying the stock and buying the put, depending on what stock you're looking at. And it can have outsized gains, but it's a different strategy entirely. The in-the-money long strangle is going to behave differently than the married put. The married put is more of a bullish position. Substituting it with an in-the-money strangle, trying to substitute the stock with an in-the-money call, creating this in-the-money strangle, well, it behaves as a strangle, not as a bullish position. But as we already saw, it starts off as a delta opposed position. At the end of August, I entered a position for Fusion subscribers in my personal account. We bought Planet Fitness at $24.60, and I bought the February 25 put for $2. Now, my total invested was $26.60, $2,660 for 100 shares, and my maximum risk was $160 or 6%. So even if the stock fell to $20 per share the following day, or fell to $12 per share, I couldn't lose more than 6% or $1.60 on my investment. On the same day, I could have opened an in-the-money strangle using the same put I would have purchased for the married put position. February 25 put at about $2. So 190 bid, 205 ask. I wanted 195. I got filled at 2 when I entered the position. And at the same time, I could have bought a February 22.5 call, which was priced at $325. Now my total out of pocket is $525. Again, it's 1/4 of the cost it would have cost me to get into the married put at $26.60. And the maximum risk is $275, because I've got a 2.5 point strike difference. So even if the stock stayed right at 24, my 25 put would be worth $1, the 22.50 would be worth $150. So I get $250 back of the $525. So the most I can lose is $275, which now the lie of leverage becomes apparent. I'm risking 52.5% of what I'm investing into this leverage position. Leverage works both ways. Is this a good trade if you're expecting a good move? We're going to take a look at that in a minute. But remember, I had to put up $2,660 to do 100 shares and 1 put. You could argue that you're only putting up $525 to do 1 call and 1 put. But you probably wouldn't have done that. You might have bought 2 positions. or 3, or 4. If you took the full almost $2,000 I invested and buy 4 contracts here, now you've got about $2,100 invested with a risk of just over $900. Okay, so that's the danger sometimes of trying to use, that's one of the dangers of using this leveraged strangle to get into a position instead of a married put, to substitute it for the married put. You're risking more monetarily and percentage-wise in most examples I've run. Even if you go down to a delta of closer to 1, the monetary, the monetary maximum risk will be higher, and the percentage maximum risk will be much higher. Also, the break-evens get adjusted. We're not planning on holding the position all the way to expiration and looking for a gain. You know, in this scenario, we're looking to make adjustments or get out of the position early. Move the call, move the put and just the married put, or trade other adjustments against it. But in this scenario, the break-even goes higher. It goes up to 27.75. Now, there's a lower break-even, meaning I can profit to the lower side if it does collapse, which I can't do in a married put. I would just have the maximum loss of 6% without further adjustments. But it's about 5 points below where we open the stock at 24.60. So it's a pretty significant drop in the position. All right? But it's a different strategy. It can give you profit to the downside as well as the upside. Doesn't behave the same way. Now, as we saw with that position, we could see a higher monetary and definite percentage gain on the leveraged strangle if the stock really shoots up in price. I've run these combinations for customers probably 25 to 30 times over the last 6 or 7 years, where they want to take a married put they're planning on entering and want to know what would be the outcome if they had done it as an in-the-money long strangle. In normal market conditions, where stock moves maybe 2 to 3% up in price or down in price in the first 30 to 20 days or so, the married put will always see a profit sooner to the upside because it still has a positive delta, where your strangle is still delta opposed until you get to that 5, 6, or 7% increase where the gain in the call now starts countering the loss in the put. On the downside, if the stock falls, I'm not gaining as much on the put as I'm losing on the stock. I'm hedging some of the decline. So if the stock falls 2% in the first 30 days, I'm only going to have a 1% loss on the non-leveraged married put position. But on the strangle, it might be 10%, okay, because I'm still delta opposed. Nothing has happened yet, and depending on the volatility, the implied volatility of your call, if it was subtly different than the implied volatility of your put, you might actually see a loss as it moves down. But that's enough of the descriptions between the two. Let's take a look now. We're going to navigate over to power options really quickly. And of course, as you know, I've already put this together for you for an example. So real quick here, and I'm going to move my screen. I apologize. Let me move my screen over to this side. It's going to be easier to view. It's going to be smaller view, but it's going to be easier to read here. Okay, let's take a look. All right, there we go. Now, there's a lot of numbers and a lot of grids here that are showing up. But here's what I want to illustrate. The top listing is the married put on Planet Fitness from August 29th. The stock today closed at 30.11. I'm in a different position. It had earnings yesterday, gapped up to about 29.90. I rolled the February 25 put up to the 30 put and sold the 30 call. So the position now has a guaranteed profit of 8.9% with a potential of 14%. Okay? Since we entered the position on August 29th, the stock has moved up $5.51 or 22.4%. And I only would have lost a static 170 on the put option. Okay, so that means that right now the married put position on Planet Fitness has a gain of 381 or 14.3% with no adjustments, no movement along with that. Okay? Now, down here below this is the prices we would have paid for that in-the-money long strangle. $325 for that 22.5 call, and again, $2 for the 25 put. Well, with the quick movement up because of earnings, the stock at $29.29, actually it's trading at $30.11 at close today, the puts dropped to 30 cents. But I have the same $1.70 loss on the position, on the put. But we see here our call that we entered is trading at $7.80. It's up $455. So that means I have a monetary gain of $285 with the in-the-money long strangle. I have a monetary gain of $381 on the married put with no adjustments. But of course, this is a gain of $285 off of an investment of $525. So percentage-wise, because we finally saw that 22% move, this in-the-money long strangle is a killer trade. But the monetary gain is lower. Everyone assumes that even with a 10, 15, 20% gain, you're going to see a bigger monetary gain on the in-the-money long strangle because of leverage. Now, you'll see a bigger gain on the married put because of the stock has a delta of 1. Even if you go and buy a deep in-the-money February call, if we bought the 20 or the 17.5, we'd pay closer to intrinsic value, but there still would have been some time value. So the monetary gain on the married put will always be higher. The percentage gain is much lower, but I'm okay with a 14.3% gain, knowing I could have only risked 6% in the worst case scenario, even though here we have close to a 56% gain, but remember, we were risking 57% of what we invested in the position if the stock didn't move. So that's the trade-off. But all the scenarios I've run that compare the in-the-money long strangle to the straight married put position, I just don't think is a better combination, especially if you have a bullish sentiment. You did all your research and analysis looking for a bullish stock to trade a protected married put position. The in-the-money strangle isn't a small bullish position. When I open a married put, it's because I expect the stock to gain 3 to 6% in the first 20 to 30 days, maybe 20 to 40 days. With that movement, the in-the-money long strangle might not be showing a profit, where I'd be seeing a 1, 2, or maybe even a 3% profit on the married put without any adjustments in place. Of course, if the stock falls 10, 15, 20% from an unexpected event, that in-the-money long strangle is looking much more attractive. But if my expectation was the stock was going to fall 10, 15, or 20%, I would have done a different strategy than an in-the-money long strangle to begin with. By the way, another comparison, I have it here for you too. Here's the out-of-the-money long strangle for ATVI, where we currently have a gain of $30. Our calls moved up. The stock's at 63.03, so the calls moved up 32 cents, and our puts declined 2 cents. With the reverse, and this is weird, this is more of an implied volatility shift from yesterday's sudden move down to a little correction, a little increase today. It came back up and then went back down a little bit again. But it's just interesting to see that one day after the trade, the in-the-money long strangle, the puts down 44 cents, the call's up 22, and that's at midpoint. So this is at a loss of 22 cents, where the out-of-the-money strangle is at a gain of 30. I don't expect to see this every time, but it's just an illustration how the out-of-the-money strangle, 65 call, 61 put, is actually showing a gain right now, where the in-the-money strangle, the better delta, the better position with the in-the-money options, is actually showing a loss of 22 cents. Not a big loss, not a big gain, but it's kind of interesting that the one-day trade we had a customer email about yesterday, the out-of-the-money strangle is actually performing better than the in-the-money strangle. Kind of unique. All right. Well, now that we're here at Power Options, we're actually going to switch views a little bit here so I can increase the size of what we're seeing on Power Options. I'm going to get to the 3 or 4 questions that have come in. Okay, that's just my brief discussion on the in-the-money and out-of-the-money long strangles. Okay, first question that came in. Okay, let's see here. I'm sorry. Okay, so Rajiv, I'll get to that in just one moment. I see Rajiv's question. San, S-A-N, not Sam who's normally here, but San, S-A-N, wrote in and says, my question is that it is better to sell weekly covered calls in the position with defined risk with the long put option. How is it different from other income methods? Okay, we're talking about these two questions related to the married put strategy, the first two I'm taking, so we're going to address those first, all right? Am I showing the right screen? No, I'm not. There we go. All right, so here we are at the married put tab. Here we are at the main married put tab on power options. And we, of course, see the profit and loss chart of the limited risk position. And the question, of course, as I mentioned, came in from San about, can I use weekly options to sell against the long put position? You can. And the 12 different income methods we discussed in the blueprint, you can use weekly options to do that. However, don't force a trade using a weekly option just because a weekly option is available. All right, let me take a look here. Let's go. I want to do it a back test way. I'm going to do it a back test way. I'm going to go back test. So this is some of our historical tools we use in power options. And I'm going to do a historical search on this position. And we're going to look for a married put that matched our default criteria, right, let's say from the 2nd of last week. Yeah, November 2nd, 2nd of the month, last week, right there. Let's see. So we're going to go to Thursday, and I'm going to use the standard RadioActive search. I don't know if any of these stocks have moved up, but we'll be able to see. What we're going to see here are the actual positions that match this search criteria at the close of November 2nd using our historical tools. Now, it takes a little while. I apologize for that. The reason why is because we're uploading all the information. Okay. So we know Netflix has weekly options, a little expensive. We know Adobe does, I believe. Skechers, I think, does too. Let me just take a look here at something. Let me just take a look real quick. Just going to figure out where these two are. We're going to take a look at both of these and the pros and cons of the different positions. Okay, so SKX, 1 second here. Not that big. A couple of positions did have lower movements. Okay. No, don't want that. Okay, just give me 1 second, folks. I'm just looking for one. Ow. Half of these didn't even move in the first week. That's all right. Let me see if one more. Let me see. I'm doing something in the background here. I apologize for the delay. I just want to see one thing. All right. I'll take that one. Okay, sorry. We're going to take near the bottom, and it's not the best of positions. It's actually going to come out pretty good in your favor of your suggestion. But let's go ahead and take a look at this here. All right. So I'm going to go with Vive down at the bottom. And on November 2nd, we would have opened Vive at 60.95 and at the same time bought the June 70 put for about 12.30. Low risk here. I probably would have gone with the 65, honestly, if the risk was under 7.5%. That's okay. Let's just take a look at this position. What I'm going to do now is go back and add it to the portfolio tool. Let's just create a new, I'll just add it here. We'll just add the married put to our existing one. So VEEV 11.2, 60.95. And July, you know what, I have to use those prices. I would have gone to the 65, I'm sure. But let's stick with the 70 because that's the one that came up on the search. And same price, 12.30. How about that? Okay, so let's submit it. Now, we know that we have the historical tools here to show us the search results in any strategy based on a selected date, but I'm going to go to the option chain very quickly. For November 2nd, It didn't. I thought it did. It didn't. Okay, but that's all right. So 15 days out, this is a terrible example. This actually ended up being a terrible example. I do apologize. I thought ViV had weekly options. That's why I took it. Okay. Not a problem. Let's just take a standard one. What you would have seen here, let's go back to the portfolio. Let's take a look at the profit and loss chart very quickly. The key here to remember is that in this position, I am invested with $70 or so, okay? But what are the only options that are in the weekly series? Remember, my cost base is $73.25. If ViV did offer weekly series, it'd probably have single strikes, right? 61, 62, 63, maybe even the 65. But the premiums you would have seen were maybe 40 cents for the 61, maybe 50 cents. When the stock was at 69.5, yeah, we'll call that 50, and maybe 35 cents for the 62, maybe 20 cents for the 63, maybe 17 cents for the 64, and maybe 10 cents for the 65. Okay? The reason why you don't want to force a sale of an option, even if weeklies are available right away, is because none of these options would work. You're selling a call below the put strike price, which is a no-no, because you spent all this time, you spent all this time researching a stock that you felt would move up in price. That's why you got in the position. By selling a call right away, you're going to create a position where you're going to increase the loss to the upside. You're going to create a bearish position because the only premiums you're going to find are the ones that are at the money, that are very much below the put strike price. So even today, if this was my position and the stock has moved up to 61, let's say I sell a 1 week out option 7 days away, and I sell the 65 call, which is only worth 10 cents. It's a little bit out of the money. It's 4 points out of the money, but it only gives me 10 cents. Look at your risk. It went up to 11%, not to the downside, but to the upside in the direction you thought the stock was going to go. That's a danger. That's the risk of trying to sell week by week by week options, because your original analysis was you would have opened the married put if you thought the stock was going to move up 3 to 6% in the first 30 to 40 days. If you force the sale of a weekly option for a very low premium, well, you're trading against yourself. Buying a put isn't trading against yourself. Buying a put is ensuring your position, okay? And that's smart, okay? There are other ways to ensure it, I know, but that's a smart move. Selling a call, trying to generate income just because it's available on a weekly series is not a good idea, because you're going to put yourself in a worse position. Let's run a search today. Here's a good one. A little bit of a high risk, but it's okay. Now we'll take Netflix. Currently at 192. April 195 put at 1990 gives me a risk of 8%. We know Netflix has weekly options. We're going to try to get a better price here. Let me take a look at the April 195 put on our profit loss chart. 1935 to 1990. Nope. 1963 is direct midpoint. So we're at a risk of 7.9%. But remember, bought the stock at 192. Anticipation. The stock has the potential to move up 3 to 4% in the next 20 to 30 days, or maybe even 1 or 2% in the next 10 to 14 days, if you look at it that way. So here's my position. I've got insurance out to April. I've got a low risk of 7.9%, higher than I normally take, but let's sell a weekly option. Weeklies are available. I want to sell a weekly call for next week. Of course, every series has an expiration next week because it's standard expiration. Well, I can get 272 for the 192.5, maybe 279, about 175 for the 195, $1 for the 197.5. Let's try that. It's good dollar premium, 7 days out, 197.5 call. So we'll add that in. We're going to sell it for maybe even a little bit more. Let's just put in $1. Remember, my maximum risk is $16 or 7.9%. Taking away $1 from that to try to generate weekly premium. Now, in this case, it's all right. The risk goes down to 7.4%. Now, here's the trade-off. If the stock moves up 5 points, okay, the stock moves up roughly 5 points, 5.5 points to 197.50, where I sold that strike for $1, you could make about 1.8% in 7 days. Not too bad. And that's including the theoretical value that would remain on the put. But remember, your target was higher. You were thinking the stock might move up 3% or 4%. If it does move up 3 or 4%, you're seeing this decline. In this case, the risk didn't increase. Why didn't the risk increase? Because you actually did the right thing. And you sold a call above the put strike price because it had a reasonable premium. It's less than 0.1% of the stock price, okay? If you tried to force it to that lower strike of the 192.50 or even the 195, you're likely going to see your risk increase to the upside. So let's do the 195 equal to our put strike price right now at 175. Okay, so I've got the 195 put, selling the 195 call at 7.1. It's still lowered, but now you've got an upper and lower break even, because you have to remember that your total cost into the position, not just where your put is, but your cost in the position, if you sell a call at a strike price below your cost basis, that's going to give us 2 ways to lose. That's the danger of selling the call too soon, and especially for too low of a premium. Okay? Now, sure, the stock just stays at 195. You keep that 176 premium. You've lowered your risk to 7.1%. That's fantastic. But you got in this position because you thought it was going to be up in this range, that it might move up to the 200 range or so in a 20 to 30 day period. And if it does that, now you're buying back this 195 call for $7, $6, $5, and you only collected 175. So now you're adding to the cost basis and increasing the risk. That's why we don't force the sale of a weekly option in the radioactive positions too soon. Sam had mentioned that, if you're doing a tighter spread, meaning that if you just went 4 to 6 weeks out with a 195 put instead of following the guidelines of radioactive trading, if you just went 4 to 6 weeks out, you can sell weeklies and get a better profit and loss chart. And he's right, because you pay it in less time value. But again, the structure, the common structure we talk about, we're going at least 150 days out in time. Okay? And in that case, you've got to wait for the stock to move up to match your expectations. Even if it offers weekly options, if you force the sale of a weekly option as fast as you can, week by week by week, and you're doing it at a lower strike price or too little of a premium, you can see your risk increase to the upside. You can give yourself 2 ways to lose, upper and lower. And you might just have too small of a gain for a 7 to 14 day trade. Whereas if the stock moved up 4% over the next week, as I expected, sooner than I expected, but still moved to the target I expected, if it goes up 4% in that time frame, I'd have a 2 or 2.5% gain on the married put with no adjustment. Here, well, the best case scenario is 1.5. If it moved up that 4% or so, I'm only making $100 because I've capped my gain. Even with income method number 6, where you leave the upside open, it's dangerous to try to force the weeklies just because the weeklies are available. All right. Daniel asked a question shortly after you. He said, can I trade the radioactive techniques with only $10,000? Yeah, that's how I started, actually. Originally, I only allocated about $5,800 to radioactive trading, and I was trading married put positions that I was comfortable in were growth stocks in the $15 to $20 range. And as I build my account, $20 to $30 range, $30 to $40, and so forth. Okay, but yes, you can start out with $10,000, you might only be opening a few trades, 2 to 3 trades at a time, maybe 4, but you're going to be in that under $30 range, which is perfectly fine. Planet Fitness, for example, you saw is already at a 14% gain on that position, with the stock being at 30 right now. It was a $24 stock when I got into it. I also have ATVI, which is a $60 stock, but that's because my account had moved up. All right, so let's see here. Question, comment from Haroon. Haroon says, I am new. Sometimes I like to trade the E-mini S&Ps, future symbol ES. Yeah, we don't recognize the futures. We don't recognize the E-minis, the ES. Your general question is sometimes you trade those. PowerUp doesn't recognize it. Oh, it's a repeat. Okay. Yeah, so sorry, Haroon. We don't track ES. We don't track the future strike price. And that's kind of the issue. Sand says, but if you sell, going back to that radioactive trading discussion, he says, but if you sell a call above the put strike price, yeah, that's right. That's what income method number 1 is. The rules in the blueprint, you never sell below. So I get into Netflix and I sell it above. Well, Netflix is a good scenario, okay? But what about something that's not $190? What about a married put on a stock that's trading at $50 or $60 that offers weekly options? Okay, for example, I'm just going to do it on the fly here. I know it's a $62, $63 stock, so let's go back to ATVI. And am I June or am I May? Yeah, I'm May. Stock at 63. I'm going to do the 65. Let's look at that on the profit and loss chart, okay? So I buy ATVI at around $63 per share even. The May 65 put, trading at 690. Okay, so I want to sell a weekly option with the stock at 63 and I've got the 65 put. Go out 1 week, 65 strike, 20 cents. Is that worth it? Is that really worth it to generate 20 cents on this position? Well, I agree. It's 20 cents you didn't have yesterday, but at the same time, if I got into the stock because I'm bullish and I'm expecting it to move back to $64 or $65 in the next 10 days, I'm going to wait for it to go to 65. And then I might sell the 24th, November 24th, which is 7 days out, at maybe the at-the-money premium, 78, 80 cents, or maybe I can get the 66 for 48 cents, 45 cents, as the one strike out of the money we're seeing here, because my expectation is ATVI will be up to 65. If it goes to 66 next week and I sold this for 20 cents, I now have to pay it back for $1. So I lost 80 cents. I've added 80 cents to my cost basis, which means I've added 80 cents to my risk. Don't force it. Wait for the stock to show its hand. If it stagnates, that might be a good move. If your sentiment changes and you say, okay, well, I don't think it has a chance to go above 65 in the next 7 to 10 days, that might be a good play. By the way, ATVI is not the position that you want to sort of guess that with. I know because I've been trading it for several months and I'm coming to expiration and closing out the position. But yeah, it goes up to 67, has a good build, hits that 65, 66, big drop down, big gap up, right at 65 again, and then back down. Monday or Tuesday of next week, I wouldn't be surprised if this was at 67 again. I also wouldn't be surprised if it was at 61 as it was earlier this month. Okay, that doesn't surprise me. I'm in a locked-in profit of about 5%. Whether the stock goes to 61 or to 68, if it did go to 68, I might manage it for higher upside, but I'm at a guaranteed profit. I'm on a conversion on this position right now, where no matter what the stock does, if it's below 65, I make about 4.6%. If it's above 65, I make 4.6%. If it really gaps up above 65, I might go higher, okay? Don't force the income method. Don't do that. Okay, wait for the stock to show its hand. Follow the rules in the blueprint, okay? Oh, and San follows up with kind of what I just mentioned. He commented earlier, the only problem would be now that would be you're in and out too many times selling the weekly covered calls also. That's right. The covered call does cap the gain. When you sell a call in a married put, as we saw in those profit and loss charts, because you don't think the stock is going to go above that short call. It's really a neutral to almost bearish strategy. When you sell the call, you don't want the stock to continue to move up. You want it to stay below that call strike price so it expires, you maximize the premium, and then you could look to sell another call. If you're still bullish, just selling the call is the almost worst thing you could do in the married put position, honestly. Okay. All right. Let's see. And Sam had commented on those too that Sam was profiting on Roku today. He was sending me some emails about that. He was sending that as another example of one with weeklies. Saying next week if it goes up, he's going to add a call because of the high volatility, and the premiums are high for selling other options because of that as well. Okay. All right. So let's get to Rajiv's question, and it's related to this, but it's a slightly different structure. All right. So Rajiv has entered into a position for earnings the other day. Okay, he bought Cisco for an earnings event, and the trade detail for his play was he bought 200 shares at $33.78. All right, so let's add in 200 shares of Cisco at $33.78. There you go, Rajiv. And you bought the 24th of November, 35 strike. Okay, so November 24th, couple weeks out, 35 strike put, short term, and you bought 2 of those, I'm assuming, for 157 is what you mentioned. Okay, that's that part. There's a little bit more. And now planning to roll the put below the current price on the day before earnings to maximize the gain. Is this strategy okay? It's tough. All right, let's take a look at your position. You had a risk here of 1%, or only $70, okay? Okay. Okay, so now you're sitting on this position. You bought the short-term puts, 1-to-1 ratio, married put trade at 157. Okay, so we've got a 1% maximum risk on the position. Now you're thinking that you want to roll it down before the earnings. Now let me go to our research tool. Let me see when the earnings are. You've got earnings coming up on 11/15. Okay, so that's next Thursday. All right. No, I'm sorry, next Wednesday. Next Wednesday. My apologies. All right. Now, you're thinking about rolling it down. When you roll down the put, you're going to increase the risk because the credit you receive for rolling down is not going to be greater than the new strike price difference. So if I roll down from the 35, stock at 33.9, if I roll down to the 35 to the 34, I might get a 30-cent net credit, maybe a 40-cent net credit, but I'm lowering my guaranteed exit by $1. So I'm actually adding 60 cents to the risk. All right, let's take a look at just the 34 first. There are 2 things you could do. We sell the 35 now for roughly $1.40. And we buy the 34 for about 80. So again, this case, I'm getting a 60-cent net credit. Pretty good. Lowers your cost basis in the position, but you're lowering your guaranteed exit by 1 point. So our risk should go up about 40 cents to 110. Let's take a look. Let's sell 2 at midpoint of our 35s that we own, buy 2 the November 24th of the 34s. 60 cents even, the risk goes up to 149 or 2%. Okay, because now you're only guaranteed to get 34 back instead of 35. Now you could do a crazy thing. You only lost 16 cents on the original put that you purchased, but then remember you're lowering it by $1. Another thing you could do, 2 things you could do, we could go to the November 17th since the earnings are coming out there. 34 put is going to be a little bit cheaper. All right, it's not going to be 81 cents. It's going to be 77 at midpoint. So now you're getting about a 70-cent net credit, but the risk is about equal. It's about 2%. Sometimes if you roll it closer in time and down, you pay less to help hedge the loss of the difference in strike price. Okay? So now if the stock's anywhere below 34, you lose 2%, $141. Twice the original risk you have. I apologize for taking a sip right there. Okay, so that's the issue with rolling down. Now, another thing that you could do, which would add to the cost basis, but depending on what your expectations are, I'll stick with the 24th of November. I could just go in blind right now and buy 2 34 puts. Not even selling these. Buy 2 34 puts at that price of 81 cents. Now my risk is 3.2%, if and only if it stays right between 34 and 35. If it moves down to 33, a small loss of 31 cents, but not the 70 cents you had. I don't like this structure, actually. It's a little bit too much for me, but a little bit too wide of a gap for me, and I don't know what Cisco's last performances were at earnings. So adding the extra puts there to allow you to still profit on the downside if it falls is another way to go. Okay, volatility may rise, which gives extra money in this case. Well, that's true, but I don't know. The volatility might already be factored in with it coming out in 5 days. Let's take a look. I mean, you might get a little bit more of a jump as you head into earnings. Let's take a look here. We're going to go to our option research page. Doesn't matter for the 34-35 put, because they're both November 25th. So actually the implied volatility, here's the historical graph. Since this option has been released, the implied volatility is up at about 0.3, okay? And it's been moving up 0.25, 0.27, 0.29. It's been going up steadily. Maybe it would go to 0.31 or 0.32. I don't know. It's already at 93% of its implied volatility range. It could go to 32 or 33. I don't expect it to go more than that right before earnings. Cisco's not one that's going to be a volatility play for that kind of thing. I could be wrong. I'll check it next week, but I just don't think that you're not going to see too much of an implied volatility increase to really affect the price of these options on Cisco. I can't imagine it going above 0.4. I can't really imagine it going above 0.35, which would be a nice gain for you with it right now at about 0.3. But it's been moving up already in anticipation. Okay, the stock's been shifting a little bit. There was that drop yesterday where implied volatility increased, but it's been moving up consistently. You can see it here on the chart. Yeah, so in the last 2 weeks, it's already moved up from 0.2 to 0.3. It's a 50% increase. I don't expect it to go up another 50% to 0.45 in the last 5 days before earnings. You might see a little blip on the implied volatility. This is not the type of stock. A lot of times when you're in 7 to 8 days, the implied volatility or increase you're looking for is mostly already priced in. Still get another jump. You might see a little bit of movement. Don't expect the implied volatility to double. Don't expect it to go up 50%. It might go up to 0.35 or 0.34. Don't expect a large move. Sam backs this up. He just says the premiums are not there. You need to do long 6-month or year leaps because too long a trade is too low of a beta for the stock. So he's saying the shorter term put protection might actually realize a larger, what he's saying is that after the earnings, the implied volatility of your put that you bought that you are protecting might go back to norm. It might go back to 0.2, so you might see a collapse on your put because it's not far enough out. That's kind of what he's saying, okay? Different strategy. Roger jumps in and he says, do you sell naked puts? I don't sell naked puts anymore, but I will do occasionally bull put credit spreads to get into a position. Sell the bull put instead to have a known maximum loss if I'm wrong and the stock drops 10% from unexpected event. But if it drops just below that short put strike and I get put, well, I'll still trade it. If it expires worthless, it's okay. More of a fan of bull puts than naked puts. Yes, I co-authored a book on naked puts with Ernie 12 years ago, 10 years ago, and yes, I did trade them. And yes, we have historically tested screens for weekly naked puts and monthly naked puts that are both very strong over the last 29 months. So just ran new tests on them through November 2017, and the returns are exceptional for the structure we put together. So let me just start off with that. What I would use if I was opening a naked put today is I'd look at the weekly picks of the day. We're not using Delta, Roger, as our structure, okay? I'm not using Delta, for example, as one of the filters in this criteria, but in the structure of the trade itself, the structure of the others, You know, we're looking for probability above a range out of the money of 2 or 3%. Probability is a 60, 65, 63. Let me go into the choose columns field here. I'm sorry. So any of those filters I can use, I can select the view. We'll just take the top 10, top 20. I'm going to add delta into my view for naked puts. Fantastic. This is about right. Notice how, even though I'm not screening by delta, I showed you the search criteria, and you can see those on power options, but the top 25 results out of the top 15, I'm sorry, out of the total 44, but the top results, the delta is between 0.24, oh, I'm sorry, it goes down to 0.18 to 0.38 is the highest. So without even restricting delta, using other criteria for range out of the money, percent to break even, and maybe even probability, I am filtering by delta. I would say, even though I'm not using it, most likely I'd probably be using a delta of less than 0.35. And this is for the weeklies. The monthlies would kind of be about the same, okay? But you can get a little bit more breadth out of the money for longer term. So I'd say 0.35 would be my maximum. Might not look at this restoration hardware one at 0.38 delta, but let's go ahead and go to the monthly now. And I know in the monthly screens, let me go down to the criteria again. We're going 6% out of the money, but we're not using a delta screen. Okay, I'm looking for at least a minimum return. But again, all the deltas you see, 0.33, 0.30, 0.26. So in this case, for the monthlies, I'd say the average is, the maximum is probably around 0.30. So I'm going to stick with that. I don't use delta because I'm using other criteria that already filter the delta out for me. I would say, yeah, doing even the bull put credit spread, my minimum probability I look for is about 75% with 2-week outs or even 1-month out options, which kind of roughly translates to a delta of 0.25 or less. Here on the naked puts, we're looking, our historically tested results that were positive. We're not seeing it really go above 0.35 on the weeklies, and we're not seeing it really go above 0.30. The average is probably under 0.30 for the monthlies, and still getting 3, 2.5, 2.7, 2.6% yield for 30 and 35 and 40-day out trades, which is pretty acceptable for the better probability. So if you want to use delta, 0.3, 0.35, okay? All right. Okay, and Rajiv was talking about we'll do it if the stock falls in case there is no volatility rise on his positions. Okay, Roger, yeah, so whether you're doing monthlies or weeklies, you can check out the picks of the day, but a lot of times, and I've always done this too, we've done this in the past too, in the webinar section under the options concepts, I have a webinar there that's Greeks and why you may not need them. And I'm not saying you don't need to know about the Greeks to be successful in trading options. I'm saying that in certain strategies, and for me, covered calls, naked puts, collar trades, kind of even bull put credits, bear call credits, I don't even look at delta, gamma, theta, or vega at all. When I pull up my bull put screen, it's because the positions I'm opening have the stock criteria I want and the probability I want, which does sort of relate to delta, but in a different way, okay? But at the same time, I know for a fact that the covered calls that I would open, if I pulled up a list of covered calls or naked puts I would open right now, as we just saw, using that criteria, I know the deltas and the gammas and the thetas are all in a tight range without even filtering by them, okay? But it's okay. If you want to use delta, you saw my suggestions there. Naked put, maybe under 0.30. I'd probably go, usually maybe under 0.28 or something based on what I look at for my bull put spreads that are around 28 as well there, okay? Okay, Sam had just mentioned that he doesn't do naked because he got into trouble with GoPro. Yeah, I saw people get destroyed on dry ships years and years ago. It's a great trade for me. I rode it from 80 up to 120. I actually closed it at 110 when it started its pullback. Within a month later, it was at 60. 5 months later, it was at 30. 4 months later, it was at 20. Looked at it yesterday, and everyone knows what it's been doing the past 3 weeks. It bounced up to 10 on sort of that fake accounting and fake news and came right back down to $1. Then it goes up to 3, blah, blah, blah. Not a good stock to trade. I'm just saying that I know people who sold naked puts on that stock when it was at its peak at 120, and then they fell into that trap of, oh, it's got to recover, I'll just keep rolling down and rolling down, instead of taking assignment on the stock, which actually would have been worse unless they converted it to a married put. But they just kept rolling the put down, saying, hey, it has to come back up, it has to come back up, and it never did. And you never get as much money rolling down the put or rolling down the covered call defensively as you're losing on the underlying in the covered call or paying to buy it back in the naked put. Slippery, slippery slope. But again, I'll be honest with you, these criteria that Ernie put together for the monthly picks of the day and the weekly picks of the day have outperformed my return in married puts significantly over the same 29-month. My actual trades in the Fusion portfolio are being outperformed massively, I guess is the best term I want to use, by doing the weekly covered calls over the last 29 months and the weekly naked puts. Now, I've also done the weekly bull put screens that we put together. I've been doing that with a portion of my account. 40 to 50% is in RadioActive Trades, 15 to 20% is in bull or bear call spreads, and then another 15 to 20% is in the calendars. Diagonal calls has been for the past 12 to 15 months instead of diagonal puts, of course, and I've done very well with those. So why do you say, why haven't I transferred all of my account over to the bull put credit spreads or to the naked puts? That's because of the risk. Eventually the market will turn. If you don't have the right protection in place, that can come back to haunt you with the covered calls or the naked puts that we just sort of discussed with that offshoot example of dry ships. And even with the bull put spreads, sure, I know what my loss is going in, but if I take too many losses, if I take a maximum loss on a bull put, I've probably wiped out the gains on 10 or 12 previous positions. That's not a long-term recipe for success. That's why I keep a mix of those strategies with a larger portion of my portfolio into the married puts and following the radioactive trading techniques as discussed in the blueprint. And again, back to that other question, you can use weekly options at any time in the radioactive strategy, but you have to make sure if you're selling a call, income method number 1, and you want to use weeklies, make sure it matches the rules in the blueprint. Don't just sell it because it's available, because you might handcuff yourself. So if the stock continues to move up, you're actually taking a loss on the position and paying more and adding to your risk instead of lowering the risk and getting a profit, which was your original expectation if the stock moved up in price. And again, of course, rolling down the put there for that earnings might be a good idea, but you want to make sure you get the best price. And before earnings, you might want to add a couple extra puts. I can't tell you how to trade, but if you're expecting to swing one direction or the other you don't know, you might want to add an extra put so you might be able to profit to the downside if Cisco falls rather than taking the full 1, 1.5, or 2% loss after your adjustment on the position. All right. Okay, so let's see here. Okay, let me go back. I was going to switch screens here, but I'm going to go back very quickly. And Stan, I can't look it up right now while we're online, unfortunately. Let me go back. 1 second. Okay, there we go. Okay, so I'm sorry. I don't know if you're a blueprint owner, but your comment was, so you only sell if you think it will not move up within that time frame when you're neutral to bearish for a few weeks. That's right. That's what's described in the blueprint for income method number 1. Now, sure, we show you how you can manage it if it moves up above your strike price. Let's take a look at what I did the other day. Oh, let's go here. Let's take a look at what I did the other day. Here's the Planet Fitness position on the Fusion portfolio. It's bulletproof to 8.9%. Liquidation return right now is about 13%. So it's 12.5%. Okay. Yesterday, when earnings came out, the stock moved from about $26.90 up to about $29. It moved up about 4%, $4, about 4.4%. And what I did at that time is I sold my 25 put, which had dropped more than I wanted. It was only worth 35 cents, but I bought the February 30 put at $195. Okay, so that only cost me $1.60 to gain a 5-point extra gain on the position. This is 35 to 195, okay? Now, let's go back to the portfolio and power options real quick. I got 65, the best price. Okay, so let's go back to the portfolios. And let's look at Planet Fitness again. I'm going to show you what happened. You know kind of what happened. As I'm in this position yesterday, and the stock moved up, as I mentioned, what I did is I sold the February 35 cents right where it is. It cost me a little more yesterday because, unlike Sam would do, I jumped in when the implied volatility was high. But that meant that I got a good premium. Doesn't look like a good premium, but remember, this was so far out of the money. I was 4.5 points out of the money, almost 25% out of the money. I got 35 cents. We bought this for $1.95. Okay. So again, I paid $1.60 debit to increase my cost to $28.20, but now I'm guaranteed to get 30 back. Well, that's not right with those numbers. It should be 8.9%. 24.60 into... Oh, sorry, because I haven't added the other position yet. I'm sorry. My apologies. Okay. So here we are. And let me go back to the chart very quickly, Sam. And I'm going to show you what I look at. Usually it's about a 3-month chart looking at SMA 20, Bollinger Bands, MACD, maybe RSI, and volume. Okay. There we go. Okay, so it gapped up and it closed above. But just the sentiment that I have with the market right now, and after watching this stock, I expect it to maybe go to $30.50 or $31 over the next 2 to 3 weeks. But I really think I was expecting it to kind of calm down. It did a little bit, came back down below 30, and then it started to move back up again. But I'm expecting it to hesitate or pull back. And so, but as I mentioned, as a result, what I did do is I sold the November 30 call, for 65 cents. This was all done yesterday, okay, or the day before. So there's the 8.9% guaranteed profit. There's the 14% gain if it's right at 30. This here, 30.12, 30.05, 30.50, 30.50, anywhere up to 30.50 is in the noise to me. Why? Because I could buy this call back right now for about 30 cents. Okay, it's 45 cents. It was 30 cents today. It was down at 29. So it already made 50% of what I expected to make by selling this call. But right now, this is in the noise. Okay, so yes, I'm expecting Planet Fitness in the next 7 days to stay somewhere between 30.50. It's terrible drawing because it's wider range, but 30.50 and maybe 29.20 is somewhere in that range. It could go up to 31, and I'm going to manage it maybe at that point. But even if it goes up to 31, I've gained an additional $1 on the stock. I'd have to buy the call back for $1, but I've only lost 35 cents on the call, right? Because I got 65 cents in, pay $1 back. That means I've added 35 cents, but the stock's up a point higher from when I implemented the trade. I'm okay with that trade-off. If I don't do anything by the time it goes to 32 or 33, then I'm maybe banging my head against the wall. But I'm really expecting it to stay in this range after this earnings surprise, a little pullback, and then I expect it to continue to go up. Okay. This is why I said in my brief, when I placed the trade for our Fusion subscribers, let's see here, big jump, 425, about 17%, and I can still sell the call. Let's see, oh, there it is. So I sold the call at 65 cents. I was looking at the December 30, which was originally around $1.20. But I decided, I think it was $1.05, but I decided to stick with only 7 days out with the November at 65 cents. Easier to manage, 9-day trade from when I did it, and instead of selling the 30 call 37 days out for $1.10, I figured the 9-day trade, little settling after earnings, a little, okay, let's go back down and see, still a good stock, still a strong stock. I still expect it to move up, but maybe a little falling back. I expect it to be under $30, as I mentioned, $29.60, $29.70 as we get closer to next expiration next week, 9 days away, 7 days away now. But if it does move up, you know what? I've got opportunities to roll out to December. So I thought this was a better play, sticking with the November 9-day out trade for 65 rather than going out to the December for, let's see, I can't remember where I put it. It's going to sell the December 30 call, but it was around 105 or something along those lines. I was more comfortable here keeping it shorter term. But yes, as I mentioned, it's because I'm expecting the stock really to stay around 30.50 to 29.20, somewhere in that range. If it goes beyond 30.50, I'll close this call. Maybe roll it to December, or maybe wait. Because if it goes up to 32, 33, and 34, it keeps going, I can get a 35 for a really good premium instead of just rolling to the 30 that's deep in the money out 1 month. Yes, you can see it right here. And because this is a bulletproof trade, even if it continues to move up, I'm still making a reasonable profit. But I sold this because whenever you sell the call, you're getting to that peak profit and loss chart, and you're right. I'm expecting the stock just to stay within this range. I could be wrong. I only did it because I'm bulletproof in both directions. I could be wrong, and if someone comes and buys Planet Fitness, I doubt it, but someone puts in an offer for Planet Fitness at $34, I'm going to be annoyed, but that's okay. I'm still bulletproof here. But if this was one of those tight positions where I would have been at a loss here, I might not have done that. Okay? You can't win for losing in this sense with this kind of structure after that good earnings move 17% on this radioactive trade. So I'm very content with that. But yes, you can see just by the profit and loss chart. If you looked at this and said, what was Mike thinking when he opened this trade? Well, obviously he was thinking it's going to be somewhere around 30, or he wouldn't have sold that call. Because that's where the max profit is. That's where the point of profit is. And that's what happens when you do income method number 1. Okay? All right. All right, just a quick one from Rajiv that came in. He said, is there a way to manage the calendar call? You had a position in JCP, 3 strike for next week, and bought position call for 1 week further. Total original cost is just $2. I don't know if you mean 2 cents or $2. The stock was trading at $2.50 at that time before earnings. I'll square the position with no loss. Wait till JCP goes down 3 till the end of next week. Yeah, horizontals are tough. Based on your expectation, I'll just do it here. Based on your expectation with a horizontal, a same strike calendar, okay? Let's take all this out. And so for JCP, you've got the 3 strike for next week that you sold, and you've got the November 24th that you've bought. All right, just put it in at these prices. Now I know Sam is looking at a more bullish expectation of this particular stock. Not that that should, I'm saying should sway you one direction or the other. Yeah, but here it is at 4 cents, okay, with the midpoint. So it's a 4 cent debit, $4 debit. Why does that look so? Oh, because it didn't go down below 3. What it really does here is this. All right, so it's at 317. So you've got a position that's kind of a tent profit and loss chart. You now have a defined risk to the upside. You've got the full risk of $4 to the downside. $5 it says. Okay, so what is management here? Well, depends on what your outlook is, and it's really hard to say. If you're bullish on this, I'd want to give myself a bullish move. I'd buy to close next week's 3 strike and maybe sell the 350 if there's a reasonable premium. That would put you in a position maybe more like this, okay, where the loss is going to be less defined here. It's more of a true calendar or diagonal calendar spread. If you're concerned about the downside, I wouldn't roll the call down. I might buy the put and take some of the premium off. It's very small, but maybe buy a put or do a calendar put spread to create sort of a double diagonal. Tough one to play, especially if you're expecting earnings, because I don't want to be in an iron condor or short strangle or double diagonal profit and loss around earnings if earnings are coming up. I want to be the opposite. I want to be in that U-shaped profit and loss chart where I can profit either direction. It's going to be hard to do. You can't do it when you've got the short call already there. Okay, so if you want more bullish premium, you could analyze maybe moving this up to the 350 call, so you'd have the long 3 and the short 350 for more of a diagonal spread. I wouldn't roll to the 4 because you're not going to have any premium. All right, it's going to cost you too much debit to do that. And of course, you could do one, a different strike, of course, by adding the put, but I wouldn't necessarily roll the call down if you're expecting a bearish movement. It all depends on what you expect next. If you're expecting a bearish movement, you want to maybe get a put here to help get you some profit to the downside. So yeah, if you're going bullish, Just like with the married put, if you think the stock's going to continue up, a lot of customers will call me and say, hey, I think the stock's going to continue to move up. I bought the stock at 48. I've got the 50 strike put and I sold a 50 call. Should I roll the put up to the higher strike if I think it's going to move up to 52 or 53 or 54? No. You buy the call back first. You adjust the call first before doing anything. Adjust the short call in this situation. When a calendar, if you think it's going bullish, what's going to hurt you the most? It's the short call, not the long call. That's going to be beneficial. The short call that hurts you the most. So you've got to find a way to close that, adjust it to give you the breadth you want if you think the stock's going to continue to move up in price. Okay, that's what you have to evaluate is what is your expectation for the position. If it's bullish, it's easy to roll to the diagonal. Yes, it is. And another thing you could do, of course, Sam mentions time to time what we do with income method number 6 in RadioActive Trade. You can roll up to that and maybe buy a 4. So you kind of create that bear call spread, but with owning a call, you might get something that looks like that still has infinite upside. Do the call ratio, Sam says. That's one way you could do it is the call ratio, where you might buy 2 3.5s or buy 2 4 calls, or roll it up to the 3.5 and do 2 buy 1. Okay, I don't want to mix it up with the ratio. That's what Sam likes to do from time to time, mix with ratios. He's more of rolling calls down and rolling puts back and forth with the short-term movement in this case. Yeah, but the risk is going to go up. That's right. The risk will always go up when you move it. You know, you've got that low debit in there. Now you said of $2. My midpoint here has us at 4. But you have that low risk of $2. If you expect upside, you could roll it up to create the diagonal as well. All right, that's what I'd look for managing the diagonal spread. All right. Well, I think that was the last question we had in, and we are just about at 6 p.m. Eastern Time. That's good. So just want to remind everyone we have some other webinars coming up next week on November 15th, Wednesday at 12 noon. Power options, we're going to talk about getting started with the search tool. For those of you that are brand new, just getting started with power options, this is going to be one of those introductions on setting up the search tool and what you might look for. Thursday, November 16th, we're going to host a radioactive trading presentation for Fusion and Blueprint owners as well as Open. We're going to talk about that Planet Fitness position a little bit more in depth. What I'm going to show you, what we're going to talk about is the moves I could have made on the Planet Fitness radioactive trade before earnings to bulletproof beforehand, and then what we could have done afterwards, and would it have been better than what we did with just waiting for earnings to happen and then making the adjustment. Okay, so we're going to take a look at the concepts of some of the income methods I could have used before earnings, how they would have performed after the earnings event compared to what we did with the position. And of course, we'll be back next Friday, as always, at 4:30 p.m. Eastern Time for a regular open forum discussion, our expiration open forum Q&A session. Okay. All right. And for those of you that haven't done it yet, remember, at any time you can just go to powerop.com, put in your name and email address. You don't need any credit card information. You can take a 14-day free trial to Power Options to have use of the tools we showed today, including access to that historical search and the historical option chain back 3 months during the trial. And then after that, the subscription levels start at $40 per month. That's for the end of day. The 15-minute delayed service is only $60 per month, and we do, of course, offer a real-time service and full historical upgrade. And the full historical upgrade will allow you to perform searches, view historical option chains, all the way back to April of 2006, so over 10 years of historical data that you can search by. And remember, of course, you can check out our blog anytime at blog.powerop.com for other free information. That webinars page I pointed to earlier, it's a public page. You can access that at powerop.com/webinars.asp. And you can toggle through the tools presentations, the options strategies presentations, the options concepts, and all of our Friday discussions are archived in that requested topics category at powerop.com/webinars.asp. And you can also check us out on YouTube at any time. All right. But if you think of a question later on, remember you can email me at any time. Just send me an email to support@powerop.com. And if you have questions about radioactive trading, you can reach us at support@radioactive trading. And remember, you can also reach us at any time during market hours at 302-992-7971 Those of you that are currently on a trial or a subscriber to Power Options, you can schedule a coaching session at any time. All right, ladies and gentlemen, thank you very much for your great questions today. And thank you for joining us. And I hope you all have a fantastic and relaxing weekend, as Sam says. He wishes everyone a relaxing weekend as well. And I look forward to seeing you as we go forward into next week's trading and get ready for expiration November 17th. Standard expiration, although as we saw today, many of you are trading the weekly options. So we probably had options expiring today, have them next week, and we'll have them the next week after that as well. Well, take care, everyone. Have a fantastic weekend. We'll see you soon. Good night.